Welcome, and thank you for tuning in to ESG Talks, a KBRA podcast series focusing on environmental, social, and governance, ESG. This podcast series highlights various ESG hot topics and includes commentary from prominent voices within the ESG community. In this episode, I speak with Joan Feldbaum-Vidra, Senior Managing Director and Head of KBRA's Sovereigns Rating Group. As KBRA has been monitoring and following trends in global environmental regulation, particularly developments in the EU and U.S., Joan and I chat about the acceleration in global green industrial spending. Joan also provides the macroeconomic context and background information on the political economy as countries vie to win the green technology race. We touch on the U.S. Inflation Reduction Act, the EU Green Deal, the EU Green Deal Industrial Plan, the U.S. Infrastructure Investment and Jobs Act, and the CHIPS Act in both the U.S. and the EU. Thanks, Joan, for joining me today. I'm going to just jump right into the questions. So over the past couple of years, we've seen a lot of policy moves by the U.S. and the EU aiming to accelerate green spending, with particular focus on technology and industrial sectors. But before we discuss those in more detail, what was the global playing field like before?
Hi, Emily, and thanks so much for having me on this podcast. Well, let me begin by saying that green spending and large-scale industrial policy have been largely dominated by China in the past. In 2019, China spent approximately 1.7% of its GDP on industrial policy expenditure. That's a conservative estimate, most probably, and it's still vastly more than any other country spend that we see. For example, points of reference are 1.7% of GDP spent by China. That's 2.5 times that spent in South Korea, about 3 times that spent in France, and more than 4 times that spent by both Germany and the US. A Bloomberg company also estimates that in 2021, China invested $266 billion alone that year in low carbon energy technology, which was 35% of what was spent globally, and more than any other country. And here again, reference points are helpful. The EU spent $185 billion in 2021, and the US spent $114 billion, according to the source. The huge investment by China has led to a dynamic where China is really dominating in the solar and critical raw material space and refining industries. Chinese companies also play an increasingly large role in offshore wind, electric vehicles, EVs, batteries, among other industries. So what does this tell us? Well, in some ways, you can say that the proverbial West was a little late to the game. Why is this? Well, one way to look at it is the EU was very focused on fiscal austerity and correcting fiscal imbalances in the decade prior to COVID. So fiscal tools were less readily available, even though the interest and the commitment to combating climate change was there. And in the US, well, it's taken us a while to get on board, as our listeners know, and there's been a lot more denial about climate change, as well as hesitance to make some sometimes painful necessary adjustments. Industry lobbying groups undoubtedly colored the policy environment here, of course, and these are democracies. But there is a third very important reason for the gaps in investment. China looks forward. It sees the future. It tries to grab at opportunities, and it takes a very long-term perspective. This was a calculated position on part of China. Greater central control in policymaking because of the political environment in China also makes the policy rollout smoother.
Thanks, Joan. I think that's really helpful to kind of have that background on what the playing field was like before the EU and US have stepped up their green spending. We've done previous episodes on ESG Talks covering both the European Green Deal as well as the EU Green Deal Industrial Plan, and I would encourage everyone to listen to those. But just as a quick recap, the European Green Deal, announced in 2019 and approved in 2020, enshrines the region's net zero goal by 2050 into law and creates an interim goal of a 55% reduction in greenhouse gas emissions by 2030 relative to 1990 levels. The European Green Deal will mobilize approximately 1 trillion euros in public and private funding for climate-related initiatives between 2021 and 2030. And then the EU Green Deal Industrial Plan, announced in March 2023, is really the EU's solution to maintaining global competitiveness for EU companies and greening the EU's industrial sector. The EU Green Deal Industrial Plan aims to speed up the process for clean technology investment, shorten permitting times for net zero projects, and scale up clean manufacturing in the EU. It also creates a European hydrogen bank, enhances critical raw material supply chains, and reforms the electricity market designed to expand access to affordable renewable energy. So, Joan, kind of with that backdrop of recent initiatives from the EU, can you talk about similar developments we're seeing in the US?
Sure. Here's a quick recap. First, there was the Infrastructure Investment and Jobs Act, also known as IIJA, that was passed in November 21. It invests $550 billion above baseline levels into U.S. infrastructure over the next 5 years. Its focus is improvements in roadways, bridges, public transport, water systems as well, but it also directs funding towards climate mitigation, social equity, and environmental justice programs. It includes investments in things like electric vehicle charging infrastructure, which is very necessary, of course, carbon capture investment, storage projects, research and development of hydrogen fuel, expanding clean energy use in the U.S. electrical grid, and promoting energy efficiency upgrades. But then there's the bigger and very bold $1.2 trillion, and that's an estimated level, Inflation Reduction Act. Now that's known as the IRA. That was passed in August 22, right after the CHIPS and Sciences Act. The immediate rationale was to reduce current and future inflation, although that was debatable on how it would achieve those, except for making costs lower. But the other goals included the reform of corporate tax policy, lower prescription drug prices for consumers, and relevant to this podcast discussion, curbing GHG emissions by boosting clean energy investment. A $369 billion provision of the IRA goes towards expanding clean energy assets and technologies over the next decade. That's a nice sum. The IRA provides tax credits, reducing the cost to deploy new wind and solar assets, to acquire new electric and hybrid vehicles, and to invest in renewables and clean energy technologies, including clean hydrogen production and carbon capture and storage.
So, Joan, you mentioned the CHIPS Act there, and both the EU and the US have passed versions of this. What is the focus of these bills?
The focus of both the European CHIPS Act and the US CHIPS and Science Act are to promote and expand investment in semiconductor manufacturing, which will be key in the development of next generation technology, including green technologies, of course. The EU estimates that the CHIPS Act will result in private and public investment of over euro 15 billion, with over euro 43 billion of investment supporting the act until 2030. The US's bill directs $280 billion in spending over the next 10 years, with much of the investment in research and development. Now, let's get to what we in Sovereigns always see as the juicy parts, the politics and the priorities. The motivation for these pieces of legislation was sparked by supply chain issues unearthed by the pandemic, but also because of general national security concerns when looking at the landscape, the geopolitical landscape, and our vulnerabilities, especially given the modernization of economies and dependence on chips and semiconductors. The US's share of global semiconductor fabrication capacity has been plummeting. It's fallen from roughly 40% of the global share in 1990 to around 12% in 2020. Given the high cost and complexity of chip manufacturing, many US semiconductor firms transitioned to what's called a fabless model and outsourced fabrication abroad, primarily to East Asia, which now produces about 80% of global chip fabrication. Some of America's largest tech firms, including the FANGs, rely on Taiwan's TSMC alone for about 90% of their inputs. The high value added, more complex chip production is also a concern. So that's the geostrategy backdrop to these pieces of legislation.
Now that we have kind of the overview of the relevant policies, can you talk about some of the dynamics that are happening here between the US and the EU?
Yes, my pleasure. That's also very interesting. Well, taken together, the IIJA, the IRA, and the CHIPS and Science Act are industrial policy of a scale never seen in the US, where in general, one could argue that the government here has shied away from directing investment or industrial policy. The idea in the US is kind of very Adam Smith-like, private actors, free markets know best, and the government is inefficient in its spending. But the landmark legislation that we've seen indicates that DC does now think that government direction is needed. The world is changing with lots of geopolitical realignments, huge shocks being COVID and Russia's invasion of Ukraine. And these were enormous shocks that were triggers for Washington, D.C. to focus on this new area. Though these bills are not specifically labeled as climate bills, they are driving a huge investment towards low carbon tech and will be important in the U.S.'s climate mitigation strategy. With CHIPS, the IRA, and the IIJA, the U.S. will spend approximately $80 billion a year on low carbon energy development and deployment, as well as other climate initiatives, potentially reaching up to $521 billion by 2030, according to analysis, for example, from Rocky Mountain Institute. But these laws have elevated concerns by some of the U.S.'s most important global partners. They have been concerned that this new policy platform could harm them economically and financially, and that their competitive positions could erode, as there are now incentives for EU companies, for example, to shift production to the U.S. under both the IRA and the CHIPS and Sciences Act. With its own policies, particularly through the Net Zero Industry Act and the Critical Raw Materials Act, the EU is aiming to reverse this incentive and increase EU manufactured clean technology while decreasing the region's reliance on other countries for critical raw materials. But still, the situation has been somewhat fluid because the US really caught the EU off guard with these policies, while they are also, of course, an important part of the US-China strategy. So it's balancing all that. This is all coming to the fore now, but here I want to emphasize that a lot of tweaks have been made that may not garner a lot of attention. And these tweaks point to greater cohesiveness with US partners rather than fragmentation.
Can you explain that a little bit more? I want to understand, what are the implications of these new policies from the US and the EU, and what can we expect to see over the next few years?
Sure, Emily. Let me just step back for a second and say, let's just take a look at the incentives for EV production, electric vehicle production, and the home bias for buying locally sourced EVs. And, this is important. Why? Because EVs are important contributors to global warming, and as a result, they're an important feature of the policy initiatives. But looking at EVs closely also tells you a lot about the policy environment and its geopolitical impacts. Spoiler alert here, as I noted earlier, it's not in actual practice an enormous change, at least from the current point of reference, at least in that sector as well. And I do think that's informative about the overall thrust of policy. But beyond looking at it from the thrust of policy and the geopolitical implications, of course, for the purpose of this podcast, it's also important to note that looking closely at cracking the nut on electric vehicles and increasing use and sales of them is so important to climate change. So, we follow the data closely on that as well. To step back even further for a brief second, if you'll allow me, the EV section is complicated from a domestic policy standpoint. And that's probably why it took a little bit of time to roll out. First, there's the fact that America is big and we like normal, the typical combustion engines, and we like to drive a lot. The picture of the American family loading up an RV or cars with trailers and a whole bunch of stuff packed and thrown into the back seat, with all the kids in the back as a representation of the American ideal. But beyond that cultural element, introducing legislation has been tough because of the impact on jobs, particularly in certain states, right? And as well as the fact that technology hasn't been advanced enough to satisfy the long driving distances that US consumers seem to like. But as we said, the China threat has been a trigger, and that has overwhelmed that. And on the EV battery front, a critical part of the EV, we have to remember that about 80% of critical minerals come from China. So something had to give, and stimulus and promises of redistribution helped solve those domestic political constraints and did pave the way for the landmark legislation. Now on to the geopolitics, which is also really interesting. Okay, so we get that China was a motivator, but aside from that, it appeared that we got some of the geopolitics wrong, at least out of the gate. But the nuanced corrections that have occurred have been important in correcting some of those perhaps unanticipated problems or errors in the legislation. Clashes surfaced because the IRA emphasized FTA partners in the legislation and rules of origin. And rules of origin benefit USMCA partners. That's the precursor to NAFTA, particularly Mexico. Immediately after IRA was published and announced, the US received phone calls from the EU and also from Korea, which has an FTA, a free trade agreement with the US, but was concerned about the local content requirement. So that was a big issue. Number one, the FTA, the fact that it was targeting FTA countries to benefit from this, and also the rules of origin piece of the puzzle. But how to solve this? Amending the IRA would require returning it to Congress, which is a big deal, especially given the election season. So what happened? In fact, the way the rollout happens is the implementing legislation is also very important on top of the legal legislation, right? So, and the implementing legislation is made from the White House. So the White House corrected the problem. And as a result, at least it seems based on the data, there was a lot of smoke, but no fires. In fact, EV imports from those jurisdictions, both Korea and the EU, have skyrocketed after the implementation of IRA. And in addition to the implementing legislation, which again was set by the White House, an important correction also had to do with the leasing specification. As it turned out, leasing cars actually trumped rules of origin and local content specification. It also trumped income level thresholds that were put in place in the IRA, as this legislation was marketed as being progressive, i.e. helping the middle class and poor families, and it wasn't supposed to be a boon to the wealthy that didn't need these incentives. So because of the implementation legislation and a tweak on leasing, as I understand it, lots of problems on the geopolitical levels were solved, although perhaps at a cost to U.S. employment in EVs. We shall see. So I guess what I'm trying to say is that thus far, the IRA has not, by some measures, really fragmented the G7 or the US's friends. Now, lots can change as it is rolled out, and the devil will always be in the details, so we'll have lots to watch. Our view at KBRA in general is that we will see attempts at greater cohesion among US partners rather than the opposite, although the road may be bumpy ahead. And important for this podcast, what does it mean for GHG emissions? Well, we take the view that coordination will likely be more constructive to those efforts than the opposite. But it's a very dynamic, fluid situation. And as we noted, it's rather new. So we will continue to learn more as it all unfolds.
Great. Thank you so much, Joan, for coming on to chat with me today. I hope that this has been a helpful overview for our listeners. And as the EU and the US continue to expand and refine environmental focused policies, KBRA will continue to monitor developments as well as the effect they may have on credit across KBRA rated sectors. Thank you again, Joan. This concludes our episode. Please email esg@kbra.com with any questions or comments. We also encourage you to visit KBRA's ESG website at esg.kbra.com, where you can find ESG research related to the topics discussed in this episode, further details on KBRA's ESG approach, and other ESG-related media items. You can also join our mailing list to access our ESG weekly roundup newsletter.